What if I told you that the money you trust every single day has already lost almost all of its real value, and most people don't even realize it? Imagine working your entire life, saving in currency, only to find out that over time, it silently lost 99% of its purchasing power. Now ask yourself, what actually held its value during all this time? Welcome to Gold Silver Scope, where we break down the truth behind gold, silver, and the global financial system in the simplest way possible. Let's start with something that should really grab your attention. Since the creation of the Federal Reserve in 1913, the US dollar has lost around 99% of its value when measured against gold. This is not a small number. This means that what you could buy with $1 back then would require nearly $100 today when compared to gold. That's a massive shift in purchasing power, and it tells us something very important. Gold is not just going up in price, the currency is losing value. Now, if you think this is only about the US dollar, think again. The euro, which started in 1999, has also followed a similar path. In just about 26 years, it has lost approximately 93% of its value relative to gold. That means, on average, the euro has been depreciating at around 11% per year when compared to gold. Just pause for a second and think about that. That's not normal. That's not stable. That is a clear sign of long-term currency debasement. So the real question becomes, is gold actually becoming more valuable, or are currencies simply losing their strength? From an analytical perspective, it's more about currencies losing value over time due to continuous money printing and expansion of the money supply. This brings us to a very interesting concept, the M2 money supply. In simple terms, M2 includes all the money in circulation, plus savings, deposits, and other liquid assets. Now here's where things get really serious. If the entire M2 money supply in the United States were fully backed by gold, the implied price of gold would be somewhere around $180,000 per ounce. Yes, you heard that right. And it doesn't stop there. If we expand this idea globally and include major emerging economies like those in the BRICS group, countries that are increasingly moving away from the US dollar system, the implied gold price could reach around $220,000 to $225,000 per ounce. Now, does that mean gold will reach these levels tomorrow? No. But what it clearly shows is how undervalued gold might be compared to the amount of money that exists in the system today. It highlights the imbalance between real assets and paper currency. Another key point to understand is that gold is not just an investment. It is a form of financial insurance. It protects purchasing power over long periods of time. While currencies come and go, lose value, and get devalued, gold has consistently held its position as a store of value. When you look at history, every major fiat currency eventually loses value. This is not a theory. This is a pattern. And what we are seeing today is simply a continuation of that pattern, but on a much larger global scale. So when analysts talk about extremely high gold prices, they are not just making random predictions. They are looking at the total amount of money in the system, the rate at which it is expanding, and the limited supply of gold. And when you connect these dots, the bigger picture starts to become very clear. We are not just in a normal economic cycle. We are in a period where the foundations of the monetary system are slowly shifting. And in such times, assets like gold and silver tend to play a much bigger role. This is just the beginning of understanding what's really happening behind the scenes. In the next part, we will break down something even more critical, the actual supply situation in the physical market, and why it could become a major turning point for gold and silver prices. Now let's move from the big macro picture to something even more important, the real physical supply situation. Because at the end of the day, price is not just about theory or predictions. It's about supply and demand. And right now, That balance is starting to look very unusual. Let's break this down in the simplest way possible. In the futures market, especially in gold and silver trading, contracts represent a certain amount of physical metal. For example, one standard silver contract represents 5,000 ounces. Now, in theory, if someone holds a contract, they have the right to take delivery of that physical silver. But here's where things get interesting. Right now, the amount of silver that is actually available for delivery, what we call the registered category, is much smaller than the total number of contracts that exist in the market. For example, if there are roughly 80 million ounces available, that translates to around 16,000 contracts worth of silver. But at the same time, the total open contracts in the market, what we call open interest, can be over 100,000 contracts. Now think about that for a second. You have a situation where there are many times more paper claims than actual physical metal available. In simple words, if a large number of investors suddenly decide to take physical delivery at the same time, the system would face serious pressure. This is what many analysts refer to as a leverage problem in the metals market. Now, to be fair, not every contract holder asks for delivery. Most traders simply settle in cash. That's how the system has always functioned. But the risk appears when confidence starts to shift, when more participants begin to prefer physical metal over paper contracts. And we are already seeing early signs of that. A significant number of contracts have already stood for delivery, representing tens of millions of ounces. This is not normal compared to historical trends. It shows that demand for physical metal is increasing, and that could slowly tighten the available supply even more. Now let's talk about another category called eligible metal. This is metal that is stored in vaults but is not officially available for delivery. It belongs to private owners. It could be institutions, funds, or individuals, and they are not necessarily willing to sell. So even though the number may look large on paper, it does not mean that metal is actually available to the market. So when people say, "There's plenty of silver," they are often misunderstanding the difference between available supply and total stored supply. This distinction is extremely important, because if demand continues to rise while actual available supply remains limited, the pressure builds up slowly, and then suddenly. Another interesting dynamic we are seeing is how exchanges adjust margin requirements. When there is less participation in the market, exchanges sometimes lower margins to attract more traders. It's a way to bring liquidity back into the system. But experienced investors understand this pattern very well. When prices start rising and more people enter the market, margins often increase again. This can force weaker participants out of their positions. It's a cycle that repeats, and it can create short-term volatility even if the long-term trend remains strong. Now, let's step back and look at the bigger picture. If we combine everything, declining trust in fiat currencies, rising global money supply, and now tightening physical availability, we start to see a powerful setup forming. This is not just about price speculation anymore. This is about structural pressure building inside the system. And when systems operate with more paper claims than real assets, they work until they don't. At some point, even a small shift in behavior, like more investors asking for physical delivery, can create a chain reaction. That's when price movements can become very sharp and unexpected. And this is exactly why many analysts believe that we are getting closer to a point where managing the gold and silver markets becomes increasingly difficult. Because the more the system relies on confidence, the more fragile it becomes when that confidence starts to fade. Now let's bring everything together and focus on what could happen next, because this is where things start to get really interesting, especially for silver. One of the biggest factors that most people still underestimate is the supply problem in silver. Unlike gold, where most of what has ever been mined still exists, silver is heavily used in industry. It is consumed in electronics, solar panels, medical equipment, and many fast-growing technologies. This means a large portion of silver is not recycled or recovered easily. And here's the key issue. Silver supply is not keeping up with demand. Every year, the market is facing a supply deficit, meaning more silver is being used than is being produced. In fact, a large percentage of silver production does not even come from primary silver mines. It comes as a byproduct of mining other metals like copper, zinc, or lead. So even if silver prices go higher, it doesn't immediately increase supply, because production depends on other mining activities. This creates a very tight situation. To find new silver deposits today, companies have to dig deeper, spend more money, and use more energy. The easy-to-find deposits are mostly gone. That means prices must rise to a level where it becomes economically viable to explore and produce more silver. Now let's connect this to demand. Modern technology is increasing the use of silver at a very fast pace. From solar energy expansion to electronics and electric vehicles, silver has become a critical industrial metal. And the interesting part is, even if the price of silver increases, it doesn't significantly impact the final cost of products. For example, a smartphone might only contain a few dollars worth of silver. Even if silver prices double or triple, it barely changes the final price of the device. That means industries are less sensitive to price increases, and they will continue to buy silver even at higher prices. This creates a powerful imbalance: inelastic demand with tightening supply. Now let's talk about the gold-to-silver ratio, which is another important indicator. Historically, this ratio has averaged somewhere between 40 to 45, and even much lower in ancient times. Today, it has been much higher, which suggests that silver may be undervalued compared to gold. But things have changed. Silver today has far more industrial use than it did decades ago. So many analysts believe that the fair ratio in the future could move even lower, possibly closer to 30 or below. If that happens while gold is rising, silver could outperform gold significantly. Now, could silver reach extremely high prices quickly? Anything is possible in a stressed system. Markets don't move in straight lines. They move slowly, then suddenly. But it's important to stay realistic. Before silver reaches extreme levels, it would likely pass through key psychological milestones step by step. What matters more is the direction. And right now, the direction is being shaped by supply shortages, industrial demand, and monetary instability. We are also seeing a shift globally, where different regions are starting to rethink how they value and trade real assets like gold and silver. As trust in traditional financial systems weakens, physical assets gain more importance. And this brings us back to the core idea. Gold and silver are not just investments. They are protection against a system that is gradually losing stability. The signals are there: currency devaluation, rising money supply, tightening physical markets, and increasing global demand. When you put all of this together, it creates a setup that cannot be ignored. If you want to stay ahead in this space and truly understand what's happening in gold and silver markets, make sure you stay connected with Gold Silver Scope, because here we break down complex financial realities into simple, clear insights that actually help you think differently.